Hello, welcome to Qianmo Accountants. Did you know that the same accounting trick can make one business look like it's booming and send another one crashing down? From creative revenue recognition to strategic expense timing, accounting isn't just about the numbers. It's about shaping perception. And perception can make or break a business. Some of these practices are common and generally acceptable in practice, but some others cross the line and are not allowed. But anyways, today we will break down the accounting tricks that can make companies look successful or set them up for a spectacular failure. Trick number 1, revenue recognition. The first big trick is revenue recognition. On paper, a company can look like it's growing fast if it books revenue early, even if cash hasn't come in yet. For example, a software company sells a 12,000 subscription for the year. Should they record all the $12,000 today or $1,000 each month? Recording it upfront makes the growth look like massive, but it hides the fact that they haven't actually earned it yet. This is how some dot-com companies in the early 2000s looked profitable until the truth came out and they collapsed. Recognizing revenue too aggressively can make a company look rich, but when bills come due, reality hits hard. Trick number 2, depreciation and amortization. Businesses can stretch out the cost of an asset for years or write it off quickly. Both may be legal depending on the accounting regulations in different countries and regions and what the specific circumstances are. But different choices change profits dramatically. Just take an illustrative example, say an airline buying a 100 million plane. Spread that over 20 years, profits look steady, but if you write it off in 5 years, the profit would look like a bit tiny, but the taxes are lower. Of course, this is just a simplified scenario to demonstrate the principle. For an asset of this value, specific accounting rules would apply in almost all countries, but just so that you know how it works. Depending on the purpose of the business, some businesses use this flexibility to show the investors smooth profits, but some others might use it to reduce the taxable income, thus reduce the taxes. Smaller businesses many times prefers to show less profits because they would want to minimize the tax liability as much as possible within what the law allows. Large businesses, however, may prefer to show smooth profit growth because they would be concerned with attracting investors and supporting their share prices. Trick number 3, capitalizing versus expensing. Imagine a tech startup spends $5 million on research. If they expense it, profits drop immediately. But if they capitalize it, they turn it into an asset and spread the cost across the years, or even in later years. On paper, the company looks profitable, attracting more investors, but in reality, that money is gone. This is how some startups keep raising money, only to collapse when it turns out that they can't generate enough revenue to maintain a positive cash flow. So it's a reminder, profit doesn't always mean cash in the bank. Trick number 4, creative liabilities. Now let's talk liabilities. Some companies use off-balance sheet financing to hide the debt. That means the company has a debt to pay off, but they found a way to not disclose it on the financial statements. People generally not be able to see those hidden liabilities unless they are professional accountants and read very carefully on the notes of the financial statements. Common examples include financial arrangements that don't appear directly on the face of the financial statements, but only in the notes. Those arrangements can possibly create significant liabilities, yet the disclosure may be just a brief sentence that is easy to overlook. Another scenario is setting up a separate entity to carry the liability and structure it in a way that avoids disclosure in the company's own financial statements. Think of Enron, the classic case, collapsed in 2001, which at the time was the largest corporate bankruptcy in the US history. One of the accounting statements was they created special entities to keep billions in debt hidden. On paper, the company looked unstoppable, but in reality, they were drowning. Accounting tricks can hide those risks temporarily, but eventually you can't change the fact that the debt demands payments. Trick number 5, timing the expenses. If you want profits to look better this quarter, delay paying suppliers until the next month. If you want to reduce tax, prepay expenses before the year end. These shifts don't change the underlying health of the business, but they can change how investors, banks, and even employees see the business. Smart timing can keep businesses alive, but if you abuse it, you construct a balance sheet on a shaky ground. So what's the thin line between smart and risky? Here is the truth. Many of those tricks may not always be illegal. They are choices. If they are used carefully within the law, they can help the businesses survive, attract investors, and grow. But if they are pushed too far, they create illusions, and illusions eventually break. That's why accounting is as much about judgment as it is about rules. Okay, that's all about this video. If you find this video helpful, hit like, subscribe, and share it with anyone curious about the hidden power of accounting. Thank you for watching, and if you want more insights into accounting careers in Australia, I've put together resources and training to help people become job ready for accounting industry here in Australia. Check the link in the description to learn more, and good luck on your accounting journey.